Hello, Smart Money Tube podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Hey, Kirk, how you doing? It's been a couple of weeks, so hopefully that everybody's been happy with Phil or whoever else has been filling in as the not so quite as good as me, but close enough.
Phil was filling in, Doug.
Hey, Phil was the Phil. All right, awesome.
Yeah. So
Now
I'm
that we've
sure
lost
people.
everybody on dad jokes.
Yeah, we can't miss you if you don't go away, Doug.
That's right. Hey, don't gotta go home, but you can't stay here. Wait, maybe that's something different.
Don't go away, mad. Just go away. All right. So anyway, so happy Halloween, everyone. It is October 31st, and get excited for Halloween. First Halloween in this new house. There's tons of kids in the street, but I don't think any of them are going to trick or treat on the street. We'll find out tonight. We've got one bag of candy. Hopefully that's enough. That's a little different from the last neighborhood where you have to have a vat of candy and it still ran out. So we'll see how that goes. But anyway.
Trick or treating is so boomer. The new thing is only trunk or treats, right? It is dangerous to go out there door to door because of all of the kids who have never been kidnapped.
Yeah, and all the razor blades that were never put in apples, and all the poisons that were never put in candy. Yeah, it's really dangerous out there.
I'm sure there's philosophies here, but where does all of this like fear? How did this imaginary fear just develop out of nowhere? I mean,
NBC, CBS.
Did you say AOC or did you say DC?
No, I said ABC,
ABC,
CBS, NBC.
Yes.
Yeah, it happens from the news.
We're paralyzed to do anything anymore. It's
the news. They scare the crap out of you.
Yeah.
And when I was a kid, when you were a kid, it was probably not a bad thing because we're all crazy. Like we were kind of nuts. Like we just did whatever we wanted. We're latchkey kids, just the way the culture was.
We played catch with jarts.
You remember those G.I. Joe things at the end? It's like, look, kids, it's a power line. Should we jump our bike over it? And they're like, yes. No, do not do that. And it's like, we needed that because we were dumb and no one told us what to do. It was kind of like, well, as long as you come home for dinner, and if you don't, you're not getting any dinner. So, we kind of self-police. So we kind of needed those little lessons because no one was teaching us. But yeah, I was playing catch with darts.
Hey, how
about this? Shooting an arrow up in the air and see how long you can wait. Remember that the Grown Ups movie? That was what we did. It was like shoot an arrow up in the air. We're like the last one to the first one to leave.
It's like all those Al Qaeda videos where now they're shooting AKs into the sky, right? And if you ever read about what happens, there's usually like a couple dozen people that get hit in the skull and killed when they do that.
Do they really? Because I didn't think that actually, because gravity, it only goes so fast. And people used to say, because there was a thing they used to say, like if you drop a penny off the Empire State Building, it could kill somebody.
Yeah.
But if you actually do the physics of it, it doesn't.
Right.
It doesn't even hurt. And I was surprised to learn that it's not because of the speed of gravity and everything. It doesn't get fast enough to actually kill you, but maybe it does.
Bullets are a little different because they're still twisting. And they're still twisting on the way down, and they are aerodynamic, and which means that they will end up going, catching terminal velocity and going through your skull. And hey, I'm gonna let you kick this off, Kirk. I will be right back. I gotta go. Right. I gotta go grab something, so I'll be back to join you.
All right, we can't miss if you don't leave, Doug. All right, so we're gonna get started here. Happy Halloween, everyone, and we're heading another interesting week. We've been pretty spot on. I'm feeling on top of my game right now because we had September pegged right and October we pegged as being a sideways month, and we've seen a lot of that. And it's just like any market. If you're not humble, the markets will humble you. So I'm not bragging. I'm just pointing out the fact that we've gone through a lot in the last few months, and some markets have just skyrocketed. Precious metals, which we've been talking about, and we said, it's getting a little toppy. We should probably take your profits and sit in the sidelines. So, the title of this episode is "Markets are taking a break. You need to follow this indicator." So, the indicator is price, and I know it's going to disappoint a lot of you, but what tends to happen, and this is kind of a lesson for the week, is what tends to happen is we get inundated with all these charts, and we share some here in the show, and I'll share some today too that kind of freak you out. We tend to get inundated with charts all the time. Scary charts, exciting charts, confusing charts. We just get inundated with them, and you look at them, and you're like, "Wow, look at that! This must be true," because immediately your mind goes to, "Well, if this, then this," right? And so naturally you think, well, this is happening, this equals Y. And most times it doesn't. So if you're looking at a chart, you have to realize it's a narrative. It's not data, it's a narrative. If it was data, you'd see a bunch of numbers on a page that you have to discern. It's not. It's basically, and I'll give an example here. Here's one that I saw last weekend, and we'll share more about it in a bit. All right. This is the London silver market liquidity. Now, if you look here, you're like, oh, wow, that's a scary time on October 9th and 10th. Look at how scary that is. And basically, this is a bid-ask spread, which is normally really, really skinny, and it got up to 80 cents, which is a huge bid-ask spread on the silver market. You might look at this and say, oh my God, there's a real problem in the silver market. Well, this is what we call a chart crime because it's only 5 days. You don't know what it was like prior to that. It could be always at 80 cents. So you're seeing this and you're like, oh my God, I'm freaking out. I need to go buy silver because there might not be any left. Look at the spreads. The spreads are blowing out, and that's terrible. All of which is technically true. When you have wide spreads, it's a really bad sign. And it means there's no liquidity when you have wide spreads. More liquidity equals narrow spreads, less liquidity equals wide spreads. That's typically how the markets work. So if you're going to buy Apple or the SPY or some really, really liquid equity, you're going to have really skinny spreads, maybe a penny. But if you're buying Acme rockets and there's a million shares out there and they trade 1,000 shares a day and you want to buy 10,000, well, good luck. You're going to get screwed over by the market makers.
But do you get a free coyote with that?
Not the kind you want, Doug, because if he's selling rockets, you know where that goes. That goes to him either blowing up or hitting a boulder somewhere. But anyway, so the point being is this is an example of a chart crime, but we were going to use it for interesting data. But in this example, it's a chart crime, right? Because you're only seeing 5 days. You don't know what happened in the last 100 years. We don't know if this is common or uncommon. We have no idea. So you're looking at this. Basically, this is a narrative. The narrative is, oh my God, crazy stuff's happening in the silver market. That's the narrative. And you're going to take away from that, I need to buy silver because there's not enough and we need more silver. I need to buy silver. That's the narrative. Now, I don't know what the words were surrounding this picture, but I suspect it's probably like, oh my God, they're running out of silver. Because I hear that all the time, even when they're not. They're always saying that. It's just a perpetual thing that they say about the silver market. Oh, we're running out. No, don't worry about that. Here's the thing, and we'll just talk about this, and then I'll pivot into silver anyway because I think it's an important thing. So you need to understand that most of what you see in charts is a narrative, and it's not instructive for where you need to go. Now, what is instructive for a path forward is this, and I'm going to share a quick chart, and you can take a look at it, and there we go. Share this. Bada bing, bada boom. And I know someone's going to give me crap for that. Okay. Oh, Jesus. This is killing me. Oh, wow. I hope this thing doesn't freeze. This is a chart for Apple. Oh, boy. What in the hell? All right.
I saw Microsoft. Close enough. Same concept.
There we go. All right. So this is Apple. And when you see this, right, is Apple in a bull market or bear market? Well, you look at this, it's like, wow, they're doing pretty well. Okay. There was a period here where they were going sideways quite a bit, but now they're breaking out. Well, I could sit here all day and talk about fundamentals, say it's good or bad and whatever, and like, oh, it's bad because of this or it's good because of this. You could sit here all day and talk about that. But at the end of the day, what really matters? Price. Price is going up. That matters. Why? Why is that the best indicator of future results? Because in the case of Apple, because it's a highly liquid stock, I'm using this as an example. But in the case of Apple, what happens? Well, if people want to buy Apple, they need to go out and buy shares. And if they want to buy shares, someone has to sell them. So you need to come to an agreement about what that price really is for Apple. Okay. Right now it's 271.31. But maybe I say I don't want to sell it unless it's 280, or I don't want to buy it unless it's 260. Well, it means I'm not buying or selling unless it hits those prices. So the price is the final arbiter of truth. It doesn't matter what research comes out. I mean, look at all these research reports down here. There's like today, look at them all. This is just today. There's like 50 today. Yesterday, there was another 75. There's tons of research reports out there about Apple. Do they matter? Absolutely not. What matters? What's the price today? Well, the price is up. What's that was the weekly. Oh, look, it's yeah. I mean, it's higher, but it's not anyway. It's a red candle. But the point is, it's trending higher over the last few months. That's a good sign. It doesn't matter what economics. I'm not a big fan of Apple because the revenues and profits haven't grown in like 2.5, 3 years, and I think that's a bad sign for a company that's predicting high growth. But people love Apple, and there's nothing wrong with it. It's a good company. It's well run. I like I said, I have my stipulations against it, but I don't own it. So what? You don't have to own it. But if I look at this as an example, it's going up. That's undeniable. I may hate Apple. I may think it's going to zero, but it's going higher. That means that the aggregate, the total of market buyers and sellers mean they agree that Apple should be a higher price. That's how markets work. Price is the final arbiter of truth. If it's going higher, it means you're wrong. If you think it's going lower, it means you're wrong. If you think it's going higher, you're correct. That's it. You can look at all the statistical stuff and you can look at all the predictive macroeconomic measures, and this is going to happen, then this is going to happen. Oh my God, look at oil. Oh my God, look at gold, blah, blah, blah. It doesn't matter. What matters is price. Now, I know this is a very narrow frame I'm giving you right now. And I'm doing that for a purpose because most people, they ignore the simplistic stuff and they focus on the complex. When you overcomplicate your life, that equals bad results. Because if you think about like, all right, I can choose between a pencil and a cap for my water bottle. Well, you've got two choices. But let's say I say you have to pick between all of these things. Which one are you going to choose? I don't know. There's so many choices. Which one do I choose? Right? It complicates your life when you have more choices. Sometimes simple is better. And so when you're looking at price, keeps things very simple. There are a lot of people who make a great living just on that one indicator, price. Now there's a little bit more to it, but not much more. Now there's a lot of people who have jobs in economics predicting all sorts of things that never come to pass. And there's all sorts of people doing deep fundamental analysis on mutual fund portfolios to make sure they pick the right stocks. And they end up underperforming the index. What does any of that matter? Now, I'm not saying it's irrelevant. I'm not saying it's not valuable. I'm saying that what really matters is price. If something's going up, buy it. If it's going down, sell it. It's that simple. And I know I'm oversimplifying it, but it doesn't get much more complicated than that. Because if you're buying something that's going down, and you're like, well, it's just, it'll come back up. It means you're wrong. Get out, right? And you have to understand where to buy and where to sell. So if you think it's going higher and it starts going down, where are you getting out? You're getting down, are you getting out at 1% lower, 10% lower? If you don't know that, you're guessing and you're gambling. If you get into a stock, if I get into ABC stock and it's at 50 and my prediction is going to 55 and it won't go lower than 49 and I buy it and then a few weeks later it goes to 48, I got to get out. I should have been out at 49. I was wrong. Now, it doesn't mean it's not going to go to 55. It means that I was wrong in my thesis, because my thesis was it's not going to go more than 2% lower and it'll go 10% higher. That's my thesis. So if my thesis is wrong, I need to get out and find a different thesis or find another stock. Don't sit around and wait. Now, if you're a value investor and you're buying for 10-year cycles, great. You know the price you need to buy at. Warren Buffett's great at this. He's been selling puts for decades and making great money, waiting for the right price, and finally gets it. Great. I own the stock I want at a great price. It doesn't matter if the stock goes down 20 or 30% from where he buys it, because he bought it at the price he wanted to buy it at. Now, most likely he'll buy more if it goes lower. But the point is if something goes on sale and you want to buy it, you buy it. If it goes on sale and you thought it was going up, maybe you should sell it, right? Price is the ultimate arbiter of your truth, okay? Just because there's a stock out there doesn't mean you have to invest in it. I just had this long conversation with a client just before this, and we were talking about this issue. It's like, people are like, oh, we're going to miss out. We're not in the AI stocks. So what? Why do you have to be in AI stocks? Because everyone else is doing it? What is this? FOMO? What is this, like, everyone has to agree on the same stuff? No, that's what makes a market. Everybody disagrees with each other. That's the whole point. You figure out what you want, and hopefully you're correct. So don't feel the need to buy into stuff. Don't feel the need to follow indicators that are speculative. Look at the one indicator that indicates truth, and that is price. So now we're going to go over all the unimportant indicators today that I saw that are interesting to me, but not as interesting as price. This is a public service announcement. Hi, my name is Kirk Chisholm, and I'm with the government, and I'm here to help. Doesn't that sound reassuring? Well, let's talk about how they're helping. The government needs your help to make our money worthless again. PPP loans, student loan forgiveness, helicopter money. Let's keep the party going until our money is totally worthless. Don't think it can happen? Sure it can. Just ask Zimbabwe, Venezuela, Greece, Germany, Hungary, Greece, Yugoslavia. Did I say Greece? As a loyal listener to their show, I want to give you free money. I'm giving away free money in one of these hyperinflationary currencies. Go to www.moneytreepodcast.com/free money and follow the instructions to get your free gift. I have a large audience and only a limited supply of these currencies. I'm not the Federal Reserve, so I will run out at some point. Make sure you get yours before I run out. Go to moneytreepodcast.com/free money. Follow the instructions and get your free money today.
Well, I think the first thought that I had, I like the last thing you said is, why do you think you got to be in the emotion of it? Like, I just met with someone the other day who has been jumping all over AI stocks, and the AI stocks are, they're shiny. They're certainly, becoming a greater component that's embedded in our system, and obviously the opportunity to excel with those types of speculative investing type of opportunities is huge, and everybody sees what Nvidia has done, and there's a lot of questions obviously about how Nvidia value and profits and the way they do their deals. It's still out there making people scratch some heads. But I'll also tell you, this individual has about $100,000 in losses right now. Why? Now, it was funny because we had a conversation. This person is going through some personal stuff and needed to get cash. I was like, well, sell your losses, because now you're going to be able to free up these gains and free up this cash. And we talked a lot about harvesting losses all at once, etc. But the bigger question was just trying to understand, like, why do you own all of these things? And, and a lot of the investment was, again, it was because they see the future being in this world, which nobody disagrees. Let's go back to 1998. Everybody knew that the world was going to wrap its head around the internet. It was coming. But unfortunately, I don't know the specifics, but let's just say 90% of all the companies that were caught up in that wave at the time, the buy.coms, which were I can't remember how much, $100 a share at the point, was like, oh my gosh, look how much money I'm making. Unbelievable returns in the markets. And then what happened? The reality is it was only a few players that ended up sorting themselves out in the long run. And that's kind of where we are right now with the wild, wild west of AI. So just because and if you look at the time, there was lots and lots of people making tons of money on the internet at that moment. Just like there's tons of people, I don't know, tons, but there's, certainly sounds like there's tons of people making money on crypto. But there's all these other types of, what we call S coins out there, and things that have been created in this wave that people are jumping into. And guess what? They can brag that they're making all of this money right now off of it for the time being. But underneath those valuations, the problem is, and this goes back to Warren Buffett, and I know you got a good chart on this one too, is you don't know who's swimming naked until the tide rolls out, right? And there's a lot of people swimming right now in that tide. And as long as the tide's in, everything looks hunky-dory. But there's a lot more that has to go into it. And unfortunately, you've got to look past the emotion and really understand who's fundamentally positioning themselves for the future. And the last thing I'm going to say on this is, even what is that future? They just reported, and I think it was Microsoft, Google, I can't remember who else was it was in this list. 87 or so, 80 and change $billion investment in AI. So bodes the question, are they investing in AI because AI is the future, and therefore AI is going up because of this investment? Or now is it that they have to push AI because they are so heavily invested in it that now it becomes mandatory from a business perspective to make sure that this future becomes a reality because of the speculative investments that they have done at an infrastructure level? That, granted, is it going to play out there? Yeah, we're seeing that AWS from Amazon is still very successful in this, and they've shown some movement there. Oracle not Oracle, but Google absolutely has as well. But to the point of kicking in $87 billion back and then some, there's a lot of questions out there that remain, and CIOs are scratching their heads all over, especially now that they're facing all these new economic realities with the government shutdown. It'll remain to be seen where they put their focus in terms of short-term and long-term band-aids versus operations.
Yeah. The idea of people swimming naked, it's maybe I have the wrong images in my head. Some people just shouldn't be swimming naked. That's just the way it is. So I found this tweet, which I was laughing at, and it looks like it was on Blue Sky Social, which I thought Carl was a conservative, so it's kind of funny he's posting there. But anyway, so the tweet is basically, last year 3% inflation, throw the bums out. This year inflation's defeated. Like, I just found that hilarious. But this is an example of what I was talking about earlier.
And 3% right? Either way, right? Exactly. Right, it's 3% right. Either way. It's all about the narrative.
Right. It's just about the narrative. Like, it's 3% both times, but yet it just depends on what the narrative is. It's the same set of facts, right? And this is what I said 2 weeks ago, and I got a lot of hate mail for this. I say, data is useless and facts don't matter. I got a lot of hate mail on that, but it's true. Look at this. This data is the same. What does it matter? The data doesn't matter anymore. We're past the stage where data matters. And frankly, data is all fake anyway. 3% based on what? Right? It was what, 8.3%, 9% at the peak? Well, anyone who's been to the store knows it was like 100% inflation over like a 2 or 3 year period, not 23%, which is what they stated. Absolutely not. So our data is all fake. You can't trust it. And that's okay, right? It just means, what it means for most people is, don't spend your time focusing on the data too much. Because if you spend the time focusing on the data, you miss the greater picture, which is stock prices are going up, right? And that's the truth. And it doesn't matter why, right? We talked about this a few weeks ago. Why doesn't matter. I know you want to feel like you have an answer, but it doesn't matter why. And I spend hours a day talking to clients about why. But the reality is why really doesn't matter. Is it going up or isn't it? Because if it's going down, I think it's going up. My why doesn't matter. I'm wrong, right? But everyone needs an explanation. We can't just sit with something without an explanation, right? If a cube started hovering outside my window, and be like, "What the f is that?" And I got to come up with a reason to rationalize in my brain why that thing's happening. Well, I must be hallucinating, or maybe it's a new kind of drone, or I'm going to make stuff up. Maybe it's magic. Like, your brain doesn't allow you to say, "I don't know." It's just not palatable in your brain. You have to explain things in your mind and have things fit together. So here's another one I just found funny, and the list is stocks all time high, home prices all time high, Bitcoin all time high, gold all time high, money supply all time high, national debt all time high, CPI inflation 4% per year since 2020, twice the Fed's quote unquote target. Last one, Fed cutting rates again next week. It's like, really? Like, we know why they're cutting rates, because Trump is just beating them over the head with a PR mallet. And they just don't want to look bad. I mean, look, we are heading into very interesting times. Very interesting times. And there's a lot wrong with the system right now. And it doesn't matter, because what really matters is, our stock price is going up. And I'm not saying you should just hold your nose and buy and forget. Actually, we're not doing that. We are very focused on managing risk. But there are a handful of things you should be paying attention to. And here's a few of them. And okay, here's one that I thought was interesting. Top 10 stocks reach record of 41.4% of the S&P 500 in October. So all-time high of the top 10 stocks, 41. Actually, sorry, this is a potential chart crime because it's only the last 2 years. But it has been going higher for like the last 10. So I don't know what it's been historically, but definitely for recent few years. It just shows that we're way out of balance for where things should be. Also, want to point out, where's this chart here? Here we go. So I saw this chart and I wanted to kind of share it. But this is a chart of allocations. And for the audio viewers, there's public equities, fixed income, and alternatives. And alternatives are things like hedge funds, private equity, venture capital, private credit, things like that, real estate. So the allocation, if you look at pensions or endowments, like college endowments, if you look at big pools of money, historically, they've been very high on public equities. It was kind of more of a 60-40. If you go far enough back, it was mostly like 60-40. And then they started to realize at one point that alternatives gave a lot of alpha. Alpha being like, if the S&P is returning 10% and you're returning 20, your alpha, it's returning 15, your alpha is 5. Right? So your alpha is basically the returns above what everyone else is getting, right? It's your advantage, is how good you are is the best way to think about it. So for the most part, people were investing in public equities, and then people started to realize that alternatives have advantages. There's disadvantages, but there's some advantages. And the advantages are that it's not priced every day. The other advantage is there aren't many people playing in there, so you can get some price sensitivity. You can find better pricing in there. There's it helps with diversification because you have low to no correlation assets, right? Timberland in 2001 had a negative 0.02% correlation to the S&P 500. It's basically zero. And all of a sudden, institutions got involved, and now the correlation is pretty close to the S&P 500 because the institutions correlated it. Now, if you look here, what you see is that public equity share has gone down, fixed income share has gone down, and alternatives have gone up. Well, we know that because the endowment model, and we've seen that a lot, and all that makes sense. But here's something you need to know. And I don't know if I have the charts here this week, but I want to share this. I've been looking for it, and maybe when Doug's talk, and I'll look for it more. But there's something you need to know, and this is something that not a lot of people are talking about yet, but it's a big deal. And here's the problem. The problem is that you have a lot of dislocation in fixed income markets right now. And one of them is in private credit. Now, I think a lot of you probably remember 2008, probably for the wrong reasons, but you remember 2008. It was a rough period. And largely because of banks and financial institutions got greedy, and they didn't focus on risk management at all. They didn't care. A lot of sovereign governments, pensions, a lot of people lost a lot of money. Now, here's the problem. Banks are regulated. So the fact that that happened means that they were poorly regulated. Now they're very tightly regulated. So that doesn't happen again, or at least not for a while. You know what's not regulated? The private credit market. Now, people wonder what private credit is, and it's kind of like a term like hedge funds. It can mean a lot of things. But for simplistic terms, basically what it means is non-bank lending. So if I decide to put together $1 billion and go out and lend it to farmers so they can sow their fields, or if I decide to lend it to business owners, or if I decide to lend it to commercial real estate, I can do whatever I want with it. It's set up to do a specific thing. Like if I raise money, the investors want me to do a certain thing. But basically, it's this catch-all term. And because I'm doing it in a fund, there's no oversight in the same way there is for banks. So if there's problems in the private credit market that equate to what happened in banks, well, that's a real problem. We just don't see it. You see it in the banks. You're not seeing it in the private credit market. I've been hearing a lot about how problematic private credit really is right now. And I'm looking for a chart. Hopefully I can find it, but it's in rough shape. So if you want to know where the quote unquote landmines are, that one's the one that scares me the most, is the things that you don't see. It's what's under the surface that you can't see is what scares me the most. And, I don't know when we're going to see problems in the financial markets. It feels like it's going to be probably another few years. But if we do have a really adverse event, you want to look in areas that are weak. And one of those weak areas is private credit. I would not be buying GP stakes right now. Private equity is also a train wreck. What I've been seeing in private equity is they've raised lots of money. They haven't paid out lots of dividends in the last few years. And the people in there can't get their money out. So they're trying to find rubes. Oh, my dogs saw another dog. They're trying to find rubes.
I think your dog just found a rube.
Yep. Yeah, I know. Yeah.
The timing's great.
So they're trying to find rubes, i.e., the retail public, to buy their stuff from them. So let me ask you this: Henry Kravitz, founder of KKR, the firm that took on the I don't know if you guys ever remember the Barbarians at the Gate with the R.J. Aaron Nabisco, that whole thing. That was a great movie and a great book. But that whole incident, they won that, I believe, and they're masters of the universe in private equity. Do you think if Henry Kravitz is selling his GP stake to me that it's a good deal for me? No. He's the smartest guy in the room. I do not want to be buying something from some guy who's the smartest guy in the room who's selling. That should be rule number one. If Warren Buffett wants to sell you something, don't buy it. That's rule number one. Don't buy it. So that's what's going on in private equity. Private credit's a bit of a mess. I think the private markets, I would stay away from alternatives right now. I'm a huge fan of alternatives, by the way. But if you're looking at the pooled capital alternatives, I would stay clear. And we do a lot of work in this area. I don't want to say we specialize because that get me in trouble, but we do a lot of work in that area. And I can tell you, I'm not doing a lot of work in that area right now. I'm just waiting because I don't see any alpha in that area right now in many areas. There's a few we do, but not many. The few we do, we're consistent and we have this little carve out that we're safe. But for the most part, the pooled stuff, I wouldn't touch it. It's just too crazy right now. There's so much opportunity in other places, but that's not one. So you want to take it for a few minutes, Doug? I'm going to look for this, and we'll run through a few charts.
Yeah, I think one of the things that you made a mention on the private lending side. I do have actually, while you're looking at that, I do have a well. Actually, I'm gonna never mind. Hold that thought. What I'm gonna talk about here is you mentioned the banks and the concern down. And I want to come back to that because we've talked now for 2 years plus about the on paper disastrous financial condition of the major banks, and actually even worse potentially of the regional banks. And I think you raise a great question as to when is that ever going to rear its head. You can't have the astronomical levels of unrealized losses that these banks have been facing and holding on their books into perpetuity. As long as everything goes well and everybody's feeling regularly comfortable with the normal day-to-day operation of money, then they're going to be able to be in a position of being relatively immune to a significant impact of this. Because right now on paper, it doesn't matter, right? Because in a way, if we talk about private equity, what the banks have as assets is a form of private equity using both hard assets, but obviously in many cases just US Treasuries. And so they've levered up on that with an opportunity to be able to collect a very conservative, arguably conservative interest rate that would, that as the federal funds rate went up, it allowed banks to just sit there. And of course, on these reserve requirements, just sit there and basically not give you any money as a lendee, or as a savings account, or however you're working with the bank, basically milk this interest rate into perpetuity. Banks, if there was any time that banks were ever deemed to be a non-conservative, an aggressive type of an institution, it was probably died out forever in the 90s, at least from on paper being willing to just lend to anybody. Now, because of what happened, or not 90s, I'm sorry, the aughts, because of what happened with 2008 and the credit crisis, because of the new rules, which they did go back on a little bit with COVID, people were, but all of that came down to how much is the government going to support us? Banks aren't going out on their own limb anymore. It's not like the countrywide financials of the world where, hey, you need money, you're guaranteed things are going to go up. We'll give you the money and we're going to collect that interest rate on you into perpetuity. Who cares what your credit rating is? Thanks to, Bernie Frank and others out there, everybody's got to get a loan. Well, after 2008, that changed. So where's lending coming from now? Well, if you look at COVID, most of the lending there, again, banks were like, we're not going to give this money out unless the federal government backs us. If you look at student loans, we're not going to give this money out unless there's some sort of, unless it's a very good credit. Again, you can go directly to the federal government, backed by the federal government, and get your money there. If you want to go and get a loan on a mortgage, well, we're not going to back that up unless the federal government backs us up through FHA loans. And so it's really come down to the banks aren't going to wiggle and do anything unless the federal government steps up and basically secures them completely. But let's look at the reality of what's going on right now. A year and a half ago, really where these unrealized losses came into play was when we had the run on Silicon Valley Bank. But what happened? That was a lot of it stemmed from, again, relieving some of those pressures, because the banks in COVID era were like, hey, we can't lend. You told us we got these huge reserve ratios we got to keep. Sorry, Fed, you put these restrictions. All right, we'll loosen that up. So I would argue that the banks are more regulated than 2008, but they're less regulated than they were in order to be able to cover with COVID. And that, of course, almost instantaneously, we ran into seeing the banks get themselves in trouble again. They're just, as conservative as are, they're just it's not even dumb luck anymore. They're just dumb. And we said that. You've got someone sitting on the Fed board who's running the bank, who knows they're going to raise interest rates, who decides to double down on buying these treasuries only to know that the value of them will tank the instant they raise. These aren't idiots. They know how it works with bonds. It's math. So let's fast forward to where we're at right now. These banks sitting on these have the kind of we don't have anything really heated that's been going on. A couple years ago, Silicon Valley Bank did. What happened? Once again, federal government stepped up. Let's do the bank term lending program. In other words, I know you've got these reserves. I know you don't have this money to support this run on because your assets are all locked away. We as the Fed will lend to you so that you can have the liquidity. And liquidity was still available for these banks to keep things moving. And that's why through, working a deal, with a merger of Silicon Valley Bank and working through what started to be a potential run on in Silicon Valley, the liquidity was there, problem solved. It's a Wonderful Life. I forget the name, his name all of a sudden, but he was there with his honeymoon money, ready to give the money out. Everything's good. Calm down. What's going on?
Mr. Potter? Is that his name?
What?
Was it Potter? Mr. Potter?
No, Potter was the banker, the ruthless.
Oh, yeah.
Bailey, yes. So
yeah.
Bailey shows his wife, Mary goes, I've got the money, right? It was their honeymoon money. As long as there was liquidity to keep the people that wanted to get money out of the bank when they were panicking solvent, it calmed everything down and they got through it. He never went on his honeymoon. He never was financially successful after that because he started by always thinking of that customer first. Banks don't think that way. Well, here's what's going on now. 3 years ago, when that bank term lending program came up, that was under the Biden administration. I'm not going partisan here, but let's just look at the situation now. Bank term lending program has expired. Has anybody who's been watching anything going on since the campaign trail in January and since looked at this administration as an administration that is going to be apt to just cough up funds? Absolutely not. We are absolutely in a quantitative tightening right now in terms, not from interest rates. Powell's lowering those out. That eases some things. But the one big, beautiful bill was an absolute gut job of available funds from the government. Student loans, sorry, $65,000 to parents. That blank check is gone. Graduate programs, sorry, $200,000 cap. Not going to be enough to even pay for your med school. Sorry, that money is gone. And do we really think that if there's a run on these banks now, that the bank term lending program is going to just all of a sudden spark? Maybe, because, they all have friends in high places. But the real issue now that I see is just happened 31 days ago. We have a federal shutdown. I talked to several federal employees who live in areas of concentrated federal employees. And it's not just in their areas. Homes that were for sale, that were on the market, homes that were getting offers, everything just dried up. Why? Everybody has pulled back. Chipotle stock just tanked. Is it the quality of their product or their pricing or the fact that the bottom of America is starting to get tapped out? Hard to say. But we know, and we've talked about this, that a lot of our GDP has been supported by government labor. Okay, there's a ton of money in jobs on the government. The government jobs have exploded. All of these people are not getting paid right now. Okay, the longer this goes on, the more those people who were okay, they were getting a paycheck. That paycheck goes into the economy and pays other people's paychecks. If those paychecks stop, then they're going to go and they're going to start having to tap reserves. And they already are. And if they're tapping reserves, they're going to need to go to the banks and they're going to need to start asking for money. Now, we have massive amounts of money still sitting in money markets, some of the most ever. It's sitting there. But the question that I have here is, if this continues going on, then we will start to see a demand or a pressure, not only from cash, but from selling of stocks in order to create liquidity. And it is a domino effect. Everything in our economy, all that M2 supply, some of the best memes out there, just like the old Three Stooges meme where I give you $1, then I give that dollar, then I give you $1, and then I give that dollar. And what do? Is we just figured out how to turn that dollar into into $6, right? That's our economy. But if that first dollar can't get given over here, it can't get given over here. Then all of a sudden, go back to these unrealized losses these banks have. We may start to see at certain banks, especially regional levels. We know that the soy farmers are struggling right now because the soy, they're literally wiping down crops because they can't sell it because China's not buying it. And guess what? Those are the ones that work with the regional banks. So now what happens? You get a run on, and now those banks have to actually figure out how to sell those assets to create that liquidity or turn to the government. Right now, my concern is that we don't have a government that's going to step up and come up with an immediate solution like we did 2 years ago. And that's when some of these challenges, these banks may actually start to come. And if this government shutdown continues, I could see it happening sooner than later, Kirk.
Yeah, no, I don't know when the government shutdown is going to end. I'm actually not worried about it. It kind of feels like maybe they should just always be shut down because I'm not getting Social Security checks. I'm not getting government benefits, so I probably don't notice. But frankly, I'm fine if they just shut down forever. They don't seem to be serving any purpose. I do like the proposal though that if that they're going to propose that they don't pay out the politicians during the shutdown or even after, because they. Yeah. I frankly think that in any given year, if you can't get together and balance the budget and do all that, and if you can't do that, you shouldn't get paid for the whole year. That's your penalty. I think I don't think it should be, that, oh, you're hurting your constituents, because none of them really care about their constituents. They're all sociopaths anyway. They're just doing it because they love power and they love attention. And I think if you think they really care, you really don't understand people. Like, they're there because they love power. So the fact is if you say you're not getting paid, or maybe you take them out in the town square and you tar and feather them, well, maybe that would be a better solution than because otherwise everyone else gets hurt, which I think is a bad result.
I want to just add on that and real quickly. I thought it was great when it was on The View that Bernie was basically saying, well, they said, you shouldn't get paid. He goes, well, not all of us can afford it. And she's like, well, what about the people? But I thought there was a better argument on that. And I don't know if we had this conversation or is this something I read offline. Instead of telling the politicians not to get paid, because, then they'll just go out and work some more backdoor deals or insider trading.
Every day.
What?
Yeah, like they do every day. Yeah. They're just underhanded deals.
Make it to where their aides don't get paid. That's when the system will stop.
I don't think they care about their aides either. I mean, I heard Bernie. I mean, Bernie's an interesting character. Like, I know a lot of people don't like him. He's a socialist, and I don't particularly like him. But I do find him interesting. And I will say, he was on a podcast the other day, and I wanted to hear him. And they asked a good question, and he just, well, here's what I want to talk about. And the guy didn't go back to him and ask the question. I'm like, that's stupid. He's just basically a puff piece. So I had to turn it off. Like, I don't want to hear a Bernie puff piece. Like, I want to hear somebody talking and grilling him. And, I mean, I like hearing different points of view, even though I don't agree with them. And I think everyone needs to do that. You need to listen to people you don't agree with, because it helps make you smarter. It helps refine your opinions better because you hear the other side. Right? And we've lost that art of communication. We're willing to listen to other people. We're willing to take it in and say, you might still argue to win, but if you can't sit here and respectfully listen to the other person and say, okay, I get your point, and I have this, we had a guest on the show actually last week, and I think she's on probably a month or two from now, but, she and I didn't agree on a lot, but that's okay. We had a respectful conversation. And even though she was actually more respectful than I thought she'd be, like, she was very, very good at saying, well, I don't necessarily agree. Here's what I think. And I feel like I did the same because, I don't want to agree with everybody I bring in the show. I actually am looking for people I can disagree with that are smart, that can have a good conversation, because that makes for interesting listening. Like, I don't have all the answers. I know that. I'm always looking to refine it. And it's like with the tariffs. People say, oh, tariffs are bad. Maybe that's what I was taught in economics, but I'm willing to listen. Maybe there's something I don't know. And I think we all have to think that way with our mental models. All right. So I found the thing in private credit. I'm going to touch on this, share a few charts, and give it to Doug to wrap up. So it wasn't a chart. It was actually a long essay that I had read, I think about a week ago. So here's the stats, and I'll kind of read them. The audio viewers will like this because, I'm reading it. But basically says since 2010, the private credit industry has experienced a meteoric rise from a relatively unknown niche of Wall Street to a $2 trillion behemoth today. For frame of reference, $2 trillion is larger than the entire junk bond market. Now, the junk bond market is dwarfed by the corporate bond and the investment grade market, but regardless, in a short period of time, it is blown up to a large part of the market. So, when you look at, and here's some other stats that basically it's a go-to funding source for corporate and consumer loans that banks shy away from. So things like leveraged buyouts, buy now, pay later, receivables, subprime auto loans. It's taking a starring role in funding the frenzy of the four largest publicly traded players in this place. So let's see, together. So if you take these four companies, they manage $1 trillion in private credit. These companies are Ares Management, KKR, Apollo Group, and looks like Blue Owl Capital. So, and if you look since January, Ares Management's down around 30% from the peak. KKR is down around 31% from the peak. Apollo Global Management is down 38% from the peak, and Blue Owl Capital is down 48% from the peak. So if their returns don't tell you something, I don't know what will. The fact that these companies are down that much in a market where most things are going higher, that should be a head scratcher and say, what am I missing here? That should be the question. What am I missing? Well, these companies, and now I understand why about a year or two ago, KKR was selling GP stakes, which are the founders, like the general partners. Like like if you start a fund, you have a GP stake. That's what you want. They were selling their GP stakes in their own stuff a few years ago. Now I know why, right? It's because they knew more than everybody else. As we said earlier, don't buy the stuff from the experts that are selling it, because it means you're the rube at the table. So it also talks about high profile blowups from private credit backed companies this year. So luxury retailer Saks Fifth Avenue was forced to restructure its debts. Here, I'm going to read this again. Saks Fifth Avenue, the luxury retailer, was forced to restructure its debts after making only a single interest payment on brand new bonds. What? WTF? So I go out and borrow money because I needed to do A, B, C, and D, and I default after my first interest payment. You know what that means? The underwriters did a shit job at underwriting it. It means they just said, we're going to take your money because people are stupid, and we're going to just pump this out because we can get our fees and move on. And they defaulted after one payment. Some people should be going to, I don't want to say they should be going to jail, but they should be losing their jobs over that. But they're not, because there's too much money and it's floating around, and it's insanity. That's one example. In September, auto parts retailer First Brands defaulted on a $12 billion debt after a failed attempt at refinancing $6 billion in bonds. Allegedly, over $2 billion in recently issued funds are missing, and now there's a Department of Justice investigation into possible fraud. Legendary distressed debt investor Howard Marks. If you don't know him, highly recommend reading his stuff. Warren Buffett reads this guy's stuff. That's how good this guy is. And he said earlier that he warned that private credit's lenders have been in such a, quote unquote, such a hurry to scoop up capital to put it to work that they've relaxed their credit standards and failed to demand a sufficient margin of safety, unquote. Now, margin of safety is what keeps your investment from losing money. And any bank worth their salt should be having a margin of safety in their lending standards. According to one analyst of a $13 billion private equity fund, Shore Capital, said, if there's going to be a crisis, it's going to be massive. So that's something I want to leave everybody with. And this is an area you're not going to hear much about. It's private. It's shadow banking system. It's in the shadows, for sure. You will hear about it occasionally. People will give you some hyperbolic stuff. But enough of the smart people in the room are saying there's a problem here. Now, it could be 3 to 5 years later before it happens, but you should be aware. I would not be putting money into private credit right now, and I would certainly not be buying somebody else's share of it. No matter what they tell you, you're just basically buying a bag of rocks. Like you're just doing you're not doing yourself any services. So I know we're kind of running over time here. I was going to share some charts. Maybe I'll do it next week.
We started late, so.
Yeah. Give me 1 minute. I'll run through these charts really quick because I named some. And then I'll give it back to Doug to wrap up. So this is margin debt as a percentage of nominal GDP. It's just a relative thing. It doesn't really mean all too much. But if you look at the peaks, 99, 2008, 2021, and then now, you just see it and you're just like, all right, what am I missing here? It's isn't that interesting kind of a chart. Here's another one we showed earlier. Silver's borrowing costs have skyrocketed. I'm going to make this statement about silver because we've been talking about precious metals for months and we've been right. And I'm humble about that. I'm trying not to sound braggadocious, but I'm trying to be humble. But I want to say that I understand the gold and silver markets well. I've been following them for my whole career. And there is, when you start to hear stories of the silver market and gold market being tight and they can't make delivery of the actual bars, and there's going to be a short squeeze that goes to the moon, and you probably see this on these Reddit posts. When you hear that, you hear people that don't know what they're talking about, because technically it's true. Well, one of two things is happening. Either they don't know what they're talking about and they're reiterating what they've heard, or they're being intellectually dishonest. Because if you understand how the futures markets work, technically that is true. It's what we call a half-truth. Technically, if they can't deliver it, they have to deliver it, or the whole exchange is defaulted, and they don't want to do that. So they need to find physical, which means they're going to pay any price for it, which means there's a short squeeze. It's going to go up. That's technically how that short squeeze happens. However, there are many things they can do to prevent that, and they have done it over the years. They did it in the late aughts, early tens, when you had these precious metals squeezes. There was one, I think, in 2010 for gold. They said, we don't have any gold, and there was a hedge fund trying to squeeze them, like deliberately trying to squeeze them. What do? They just increase the margin requirements. When they do that, people sell their silver, and now they've got plenty of silver. So there are many tools that I feel are kind of unfair. It's playing dirty pool, but there are tools that they can use, and they have used them in the past, especially with silver. They just increase the margin requirements. Instead of 5-to-1, they put it 4-to-1 or 3-to-1, or they could do 1-to-1. So there's no leverage. All of a sudden, that gets rid of all the problems, because now there's no leverage. People want to sell their silver and go do something else. That's an important context for precious metals. Anytime you hear that, it's a half truth or an outright intellectual dishonesty. I would find someone else to listen to, because it is either they don't know or they're being intellectually dishonest because they're trying to sell you fear. Don't fall for that. The exchanges have many tools, and there's more that they don't use, but they have more. They can keep that short squeeze from happening. So be careful if you're reliant on a short squeeze. This thing happening, I don't know the context. This is the borrowing costs have skyrocketed. Yes, that is true. They skyrocketed here, but I can guarantee you that's going to pop back down here. It's a short-term lease rate. But I would have loved to have grabbed this, although it's only 1 month lease rate. I would love to have grabbed this for 10 years. You just lease it out and you get your 35%. But that's a short squeeze. These are indications of a short squeeze. That doesn't last long, because people come in and they find ways to fill it, because that 35% on borrowing costs, I'd take that in a second. That's a no-brainer. So those things get solved really quickly. We talked about liquidity. This is over a 5-day period. It's a borderline chart crime, but it just shows what happens when liquidity dries up, is that you pay a lot for your bid-ask spreads. 80 cents is quite a bit for this in comparison to what it normally is. Here's a more of a historical context. London silver stocks have been drawn down. So this is the amount of silver in the London vaults. The black is the total. The yellow is the free float. Basically, none of this really matters. I just need you to look at the trend. The trend is lower. It means the stocks of silver are being drawn down over the last 5 years and is getting lower. Is it at desperate times? No, but you should be aware that it's getting lower. So when they say it doesn't exist, well, there's a whole bunch of it here. You just need to be aware that the trend is lower, and eventually it gets to a point where it's a problem, but it's not a problem today. Here's a number of the leveraged ETFs at all-time highs. People are leveraging their house to go jump into these 4x ETFs, which is crazy. I think there's a reckoning coming, and I would not be in the 4 times leverage. I wouldn't be too leverage. Leverage is dangerous in this kind of market. That's all I'm going to say. Zero options. If you don't know what ZTE is, zero date options, it means basically 0 day. It means you buy it at 9 o'clock or 9:30 in the morning, and it expires at the end of the day. These are highly volatile, highly leveraged, and as you can see, I know it's hard to see with the numbers, but as you can see, like these are quarters. It's gone through the roof. Volumes of 0 day options have gone through the roof. This is a sign of speculation. It's not a sign of market health. Yes, the weeklies have gone up, but really the dailies have gone up, and that's the dangerous stuff. When we're in options, we're in like month or quarter or year-long options. These things are highly, highly dangerous. It's just basically gambling is all it is. Leverage versus money supply. We're high leverage compared to money supply. Margin debt. We won't get into all these. Anyway, I just wanted to share that. I'll give it to Doug to wrap it up. But I just wanted to share those charts because, you see a lot of stuff out there, and I wanted to at least explain what you're seeing so you don't get duped into some of these false narratives that people are trying to drive to fear or greed. So you buy their stuff. Don't. You don't need to. Anyway, let's wrap it up, Doug.
Well, yeah, Kirk, I appreciate it. I think, some people have listened to me talk before. Have heard me talk about the, what I call the retirement income farm. And when I talk about that, I'm really referring to kind of how every dollar for college is a future dollar in disguise. And so I want to hit a reality check because invisible risks aren't just theory anymore. So you talked about First Brands, right? Auto parts supplier collapsed seemingly overnight. They're allegedly double pledging receivables and hiding billions in liabilities. Lenders like Jefferies Financial. Yeah.
Yeah. Allegedly.
Yeah. Yeah. Allegedly. Lenders like Jefferies Financial Group and UBS have found themselves tangled in wreckage, despite, believing that they were investing in safe private credit structures. Now you got Howard Marks, as you mentioned, put it in his memo. The key question isn't whether today's spreads are historically narrow. It's whether they're sufficient to offset credit losses that will occur. And in plain terms, when private credit spreads get tight and leverage builds, the next shot is already inside the system. So be aware that the shock may be there. Crash may already be in that. And why this matters to you is because whether you're funding college or locking in retirement income, you're already playing a game of cash flow and risk, not just accumulation. If you assume everything runs the same way, now you're placing a bet on the system, on lenders, on banks, on markets behaving normally. And when the system chokes, that's when your income stream gets impacted. And when college costs are still in the field, what I call the investment risk zone, and credit shock hits, you're going to now pay twice. First on your tuition, and then on your retirement income when it takes a hit. And so when your retirement is in the silo or a delivery truck that relies on credit market stability or banks lending to you, you've also already placed bets on the system. So the takeaway is not just worry about the risks you see. Okay, I've done studies on this, done work on this. Great experts have said, when the risk's already there, when things have imploded, and people say, well, now it's too late, it actually may not be as impactful as the risks you don't see. So be prepared for those risks. Retirements built on normal rules are going to snap when hidden credit risks blow. College plans built on we'll just save more later, or pay for it as we go, maybe demolished when loose credit tightens, and the one big beautiful bill already started to tighten that credit. So act early. Make sure your college funding is in the silo, not riding in the field. Make sure your retirement income is structured to survive if banks freeze. And if you're affluent, you're thinking, hey, I'm too protected for this kind of stuff. Then you need to think again. The bigger your pile, the bigger your exposure to the hidden leverage and structural risk. So if you want to lock in a plan that treats tuition like an income liability and a retirement like a guaranteed paycheck, learn more. Go visit our new website, www www.mergentadvisors.net or mergentcollegeadvisors.com. They both take you to the same place now, which is great. And then Mergent is MERGENT, MERGENT. Let's protect your harvest, not just hope for it, because the next shock isn't an if, it's when, and smart money doesn't hope, it plans.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.